Warren Buffett's Berkshire Hathaway has been building a secret position for months. He even got permission from the SEC to not have to report this position to the public until it was fully built. The reason he got this permission was because of the Buffett effect, which is how whenever Buffett buys a stock, the market immediately follows him, which causes the stock to run massively. This also causes Buffett to lose out on buying cheaper shares, since the market bids up the stock as soon as it catches wind of what he is doing. However, Berkshire has finally released the stock it has been buying, and that stock is Chubb Limited with the ticker symbol CB. Berkshire has purchased roughly 26 million shares, which is a value of over $6 billion at the close of the market today. This position now makes up roughly 2% of Berkshire's total portfolio as well, which is a decently sized position, especially considering Berkshire has just plowed significant capital into it in a very short period of time. Me being a Buffett follower, I am always interested in what he is doing. So in today's video, I want to take a quick look at Chubb so we can all see what Warren is seeing in this business. And with that being said, let's just dive right into the video. This screenshot right here comes from Chubb's own investor presentation, and this says, who we are. A world leader in insurance with a market capitalization of $105.2 billion. A truly global company with local operations in 54 countries and territories. And they say insurance is our only business. So basically, Chubb is a world leader in insurance, and they are a global company with insurance operations in over 54 different countries now. This next slide also shows Chubb's global diversification. So 52% of their business does come from the United States. 19% comes from Asia, 17% comes from Europe, Middle East, and Africa, 7% comes from Latin America, and 5% comes from Bermuda and Canada. And then you can also see all of the different countries that Chubb does operate in. So this, once again, is very much so a global insurance company. Now, this does kind of make sense when you think about it, because Berkshire Hathaway does own Geico, which is one of the United States' largest insurance companies. So seeing Buffett invest in another insurance company does kind of make sense to me, because Buffett and Berkshire Hathaway in general probably has very deep insights within the insurance industry, and therefore they must think that Chubb is a worthy competitor if they are buying the stock and now they own probably about 5% of the overall company. So then I wanted to go and take a look at Chubb's most recent earnings report to see how the business is currently doing. And right here we can see that Chubb reported its first quarter per share net income and core operating income of $5.23 and $5.41, up 15.5% and 22.7% respectively. So this insurance company is currently growing quite rapidly. Those are really strong growth rates. Then they also say net income was $2.14 billion, up 13.3%, and core operating income was $2.22 billion, up 20.3%. Global P&C net premiums written, which excludes agriculture, were up 13.3%. P&C underwriting income was $1.4 billion, up 15.4%. Life insurance net premiums written were $1.63 billion, up 26.3%. Pre-tax net investment income was $1.39 billion, up 25.7%. And annualized return on equity was 14.3%. So here we can also see that Chubb's different business lines are all growing at over 10% annually, and some of them are growing at 20% annually. So this does kind of seem like a boring insurance company, but its growth, at least right now, does seem to be quite impressive. And it's kind of easy to see why Berkshire Hathaway and Warren Buffett may be interested in this overall business. Now, if we head over to Stock Unlock, we can see that Chubb's share price has been growing very consistently over the past 24 years. Back in the year 2000, this was a $16.94 stock, and today in after hours trading, the stock is now worth $266. So it has roughly 15x'd over the past 24 years and outperformed the overall S&P 500. In fact, if we take a look at its percent returns over the past 24 years, it is at about 1,400%, which again has massively outperformed the S&P 500. So the stock has done very well over the past 20 plus years, and Buffett must believe that it will continue to do well over the long term going forward. So now let's take a little bit of a deeper look into the business's long-term financial results here. And let's start off by taking a look at the overall revenue growth. And here we can see that the revenue is currently at an all-time high of $51.57 billion, and it actually looks like the revenue growth has been accelerating since about 2020. And again, it is sitting at an all-time high now. We can also see this quick surge to revenue here in 2015 to about 2016. And I do think that this was due to an acquisition. Because personally, whenever I see large spikes like this to a business's revenue, its net income, or some sort of fundamental metric, it is usually because they acquired another business and then they see a large spike to the overall fundamentals in a short period of time. So I do speculate that Chubb did do an acquisition here in 2015 or in 2016. However, we can also see that the business has been growing strong since that acquisition, and this does look like a lot of organic growth. Now, if we head over to the net income, we can see that it actually has been quite spiky, but in the trailing 12 months, the net income is now at $9.3 billion, and it is sitting at an all-time high, which is a good thing to see. We can also see that over the long term, the net income is a little bit more lumpy, but the overall trend is that the net income is growing. Now, Warren Buffett also has a quote that he said, I don't remember the exact quote, but it's something along the lines of he would prefer a lumpy 15% return over a consistent 10% return. So I don't think that these lumpy earnings right here really bother Warren Buffett at all, as long as he is buying the business at an attractive price. Next, I want to take a look at the diluted shares outstanding for Chubb. And right here, we can see that the shares spiked in 2016. So this does kind of confirm that the business did an acquisition in 2015, and they probably diluted or issued some shares to help afford that acquisition, because this is a large spike to the overall company's share count. However, since 2016, it does look like the company has been consistently buying back shares, and the share count is continuing to drop as of the most recent quarter. So they are putting some of their earnings towards buying back shares, in addition to paying a small dividend. And with that being said, let's go and take a quick look at Chubb's dividend metrics right here. So we can see that the dividend yield is sitting at 1.36%. The dividend per share is $3.44. And over the past 5 years, the dividend has been growing by about 3% annually. In fact, over the past 10, 5, and 3 years, the dividend has been growing by about 3% annually. So it does seem like this business likes to grow its dividend at a small growth rate of only 3% on an annual basis. However, the company only has a 15% payout ratio, which means that it's not paying out a large amount of its earnings as a dividend to its shareholders. So this business does seem like it could be more focused on buying back shares or investing its earnings back into future growth for the business. Because again, it's not really paying out a large portion of its earnings as a dividend to its shareholders. So the next thing that I want to take a look at is quickly the insider ownership of this business. And here we can see that the CEO does own roughly $316 million worth of stock in Chubb. Now, this is a large amount of net investment in the company. I mean, that's more than $250 million, right? So this person does have a significant amount of capital invested in the company. However, it is also worth noting that this is only 0.3% of the business. So I know that some people may look at 0.3% and say, well, that's not a very high insider ownership. But what I like to do is take a look at this number. This is still a large amount of money to have invested in a business. And if I were the CEO, with $300 million invested in this company, I would want to make sure that the business is going to continue succeeding and that the stock price is going to continue going up, and at the very least, make sure that the stock price doesn't permanently go down and lose me hundreds of millions of dollars. So I do actually think that this is high insider ownership, and I do think that the CEO is aligned with the public shareholders because, again, they own $315 million worth of the company's stock. We can also see that the chief operating officer has about 91 million of stock, and then the vice chairman has about 65 million, and then the executive VP has about 60 million as well. So overall, these 4 executive employees right here have about $500 million invested in the company. So again, I do think that they are aligned with creating shareholder value because they are large shareholders themselves. So now let's head over to Stock Unlock's freeform tool. And what I want to do is take a look at the compounded annual growth rate to Chubb's net income over the past 5 years here from about right here. And here we can see that over the past 5 years, the net income for this business has compounded at 20.8%, which is a very high growth rate for this business, especially an insurance business. We can also see once again that the net income has been lumpy over the past 5 years, but overall the trend is up. And on a compounded annual basis, it has been growing by about 21% per year. So now let's take a look at the company's price to earnings ratio today versus its history. And now I want to zoom out to about the past decade right here, which is about here from May of 2014. So currently we can see that Chubb is trading for a price to earnings ratio of basically 11, and its 10-year historical average is about 15. So the company's current price ratio is well below its historical averages, which could suggest that the stock is looking cheap, at least relative to how the market has historically valued this business. Now, what's also interesting to note is that Chubb's revenue has been accelerating since 2020, so over the past 4 years. So Chubb's overall business growth has been accelerating and is actually stronger than it was previously. But again, the stock is trading well below its historical average price to earnings ratio of only 11. Now, also, an 11 price to earnings ratio for 20% annual earnings growth, in my opinion, is a pretty attractive price to pay for a business. I mean, think about that. An 11 price to earnings ratio growing at 20% annually. That's faster than Google grows, at least right now. So that is also interesting to note. And that does also kind of suggest to me that if Chubb can continue to grow its earnings at 20% annually, then the stock is actually looking like it could be selling for an attractive price today, when you also throw in that the price to earnings ratio is below its historical averages. Now, for me, I have no idea if Chubb is going to be able to continue growing its earnings at 20% annually. So that's the risk for me as an individual investor. I don't really know anything about this business. I don't know anything about its moat. I don't know what is causing its growth right now or what is going to cause its future growth going forward. So for all of those reasons, I am not buying the stock today, and I'm not just going to follow Warren Buffett into this stock blindly. However, I do just want to point out that at least on a metrics basis, the stock could be looking kind of attractive today relative to its growth and relative to how it has traded historically. And here is another way to think about this. What you can do is take a look at the earnings yield of the business, which is simply just the inverse of the price to earnings ratio. And today we can see that CB is offering an earnings yield of 9%. So based on how much earnings the company produces relative to its price today, it could return about 9% to its shareholders on an annual basis. Or another way to think about this is if Chubb wanted to pay out 100% of its earnings as a dividend, then it could pay out a 9% dividend to its shareholders with organic profits on the price today. This is a pretty high yield on cost, and this is exactly how Warren Buffett thinks about investing. He likes to take a look at what is the yield on the cost of the investment, and then he compares that yield versus bonds. And bonds are currently offering about 5% today. So what this means is that Chubb stock is offering a higher yield on cost than what a government bond would offer Warren Buffett. Now, additionally, Chubb has been able to grow its earnings at 20% annually over the past 5 years. So what this means is that if Chubb can continue to grow its earnings at 20% annually going forward, then Buffett is getting a 9% earnings yield on cost that is also compounding at 20% annually, which could yield some pretty high returns for him on this investment over the long term, and yields that seem to be well above what bonds could offer him as well. So again, that is kind of how Warren Buffett thinks about investing, and I do actually have videos on my channel explaining how Buffett thinks about investing and why he thinks about investing like this. And what I just explained is also in The Intelligent Investor if you go and read the margin of safety chapter. It clearly says that you should be looking at the earnings yield of a business versus what bonds can offer you, and then also try to figure out if the business can continue to grow. Because if you can get a business with a higher earnings yield than bonds, and you're confident that that business will continue to grow, then that is where your margin of safety actually lies. So Buffett must see this higher earnings yield than bonds. That adds to his margin of safety, and then he must also be very confident that this business is going to continue growing and compounding its earnings in the future. And that also adds to his margin of safety. So I do see the overall logic as to why Berkshire Hathaway is buying Chubb stock. But for me, as an individual investor and someone who doesn't know anything about the insurance industry, I don't have the conviction or the knowledge to know this business's moat or its long-term earnings potential. But with Warren Buffett being in the insurance industry and with Berkshire owning Geico, they must clearly have some sort of additional insight into Chubb, its overall moat, its competitive advantages, and again, they probably see it as a very solid insurance business. But that is going to wrap up the video for today, everyone. And that's kind of my thoughts on Chubb, just taking a very quick and dirty look at the business and trying to kind of explain what Warren Buffett's thinking may be, and also explaining how he thinks about his own investing and margins of safety, etc. If you did enjoy this video, then please remember to leave a like on it, as it does really help out the channel, and I truly appreciate it. And also, if you're new here and you want to see more stock market related content like this from a Warren Buffett follower and a Charlie Munger follower, then consider subscribing to my channel as well, because that would be pretty awesome. But with all that being said, thank you all so much for watching. I truly do appreciate it, and I really hope to see you all again in my next video.